Hello, everyone, and welcome to another day of exciting financial markets and economics. We saw, of course, and you're all aware, the Federal Reserve met yesterday and decided not to do anything with interest rates, and that was as everyone expected and exactly as I forecast. The market had tremendous volatility up and down on the day, cleaning out all the stop loss orders and all the day traders and handing a big fat check to the market price makers at the top of the food chain. It happens all the time, so that wasn't a difficult forecast. In the end, though, US equities were a little softer, and that's because no rate cut was expected, no rate hike was expected. But of course, and again, as I warned, the media put massive sort of emphasis on, there wasn't a rate cut, a rate hike, sorry, great reason to buy. So it's always on the buy side, selling the buy side, all of the financial media headlines that you see, particularly out of the Wall Street group think. So take all that with a grain of salt. It was never going to be a rate hike. There isn't going to be a rate hike. It's an election year. And the, of course, politically independent Federal Reserve won't be hiking rates in an election year. And what was really interesting about Chairman Powell's comments was that previously in years past, for very consistently, in fact, he said it doesn't matter what employment does, we actually need employment to deteriorate to help beat inflation. And yet yesterday he said, there's two forces at play in whether we're able to cut rates this year. One is if inflation data suddenly improves, which I don't see that happening, and they probably don't either, or the employment situation deteriorates. Why? Because that's votes. So now suddenly this year it matters. So just be aware the election year factor is indeed a very real phenomenon. In financial markets, we saw volatility in currencies and even in gold market. I do think gold is a massive buy because I do think the uncertainties in the world continue to grow apace. And I'm buying gold both against the US dollar and the euro because that's so volatile at the moment. I do tend to like it more against the euro, however, as I do see the US dollar being bought along with gold as still a safe haven flow, because geopolitical tensions, they may ebb and flow, but they're about the worst they've been in decades, and they can deteriorate further, unfortunately. So with Russia making significant advances in Ukraine consistently now, that makes the West more inclined to take desperate measures, which could see an escalation. And that, of course, would be, see gold a lot higher, oil a lot higher, and not be good for equities. And it would also see US bond yields a lot higher yet again. I'm still a bear on US bond yields. I put out a report the other day for the first time in several months suggesting that US bond yields may stabilize around here. They seem to be doing that, but they're still volatile. And the dominant risk overall for the long term is still higher US bond yields, that is selling US bonds, because of their fiscal largesse. Which is interesting because construction spending in the US actually fell 0.6% last month in the latest data, and is down 2.4%, I think it is, over the course of, or in an annualized sense, over the past quarter. So construction spending's soft in the US, whilst they're supposedly having a massive infrastructure build. So that's a little bit interesting, and there is massive government spending going on at all levels of government, yet construction spending is soft to declining. That is something to keep an eye on. Also, job openings in the US fell to a 3-year low, but they're still well above where they were before COVID. But it just goes to show job openings are reducing, but companies are still not really finding the right person for the right job. Problem is still in place. In other data, of course, manufacturing in the US, still soft, again contracting. It kind of stabilized at just 50.3 in the PMI, ISM PMI, previous number. Now it's dropped to 49.2. Remember, this is construction, manufacturing after over a year of recession, and it still can't do anything but sit on that low of that recessionary period that manufacturing has been in. Similarly, with the housing industry having been soft over the last year, we saw mortgage applications fall for the second week in a row, but that data is very volatile. Of course it is, because it's weekly data, but overall, mortgage applications are very soft in the US indeed, again, potentially another downward or still downward pressure on US property prices. But the real problem in the US market at the moment is that commercial real estate problem, which I do believe is going to ebb over into the Australian situation within the next few months. We could see some quite damaging data in Australia in terms of the commercial property sector in Australia. The residential property sector in Australia is obviously going to continue to boom with the world's greatest level of immigration and an economy that's just not ready for that level of immigration and struggling to provide housing for the existing population as immigration continues to skyrocket higher on the latest monthly data. Even though the federal government was saying it would slow immigration, the actual numbers continue to go higher. So the housing crisis in Australia, the high rents and higher property prices, regardless of the interest rate outlook, remain on the table. In terms of the interest rate outlook in Australia, first, just back to the Fed. The Fed won't be hiking, or it won't be hiking rates this year. The Fed won't be cutting rates for the next 2 to 3 months, 2 to 3 meetings, but it could cut rates still by the end of the year once or twice. But I don't know if that will be enough to save market sentiment, which had expected and priced in 5 to 7 rate cuts this year. US equities, I continue to warn, are in a place where institutions, the big players, are selling into every round of retail investor euphoria. They're using that liquidity to sell down their portfolios. I've been warning of that for quite some time. That's certainly what is happening. US equities had that rally on, oh my goodness, no rate hike, so we can rally, which is just all just made up spin. And then the market fell back, and now the market's having a bit of a rally. But at the same time, I don't think this rally will have legs. And I do see a change in the pattern of behavior around Fed meetings in terms of US stock market. And that suggests a new trend may be in place already, which I tend to think in the gut, if you like, that is the case. And US equities are going to continue to decline from here, which makes equity markets such as Australia's a little bit vulnerable as well. I do like the Chinese equity market. I did like the Japanese equity market, but a lot of that weaker yen, which was engineered by Japan Inc. rather well, that weaker yen, whilst pretending they didn't like it, that weaker yen has boosted Japanese corporate profits long term significantly, in fact, through the roof. So that is a strong outlook for Japanese equities. However, as the yen now begins to appreciate, and I think the appreciation of the yen will become a bit of a trend overall, as the yen sort of shows that it's not going to go any lower, some people are going to take profits on their Japanese equity positions that they had long because the yen was weakening. Now they think the yen's not weakening, so I'm going to take profits on those long Japanese yen stock positions. The reality, though, is that the benefit to corporate Japan will be long-lasting, and therefore corporate Japan stock market is a buy, but it's a buy after a correction now, I would surmise. The Chinese market, I think, represents great value as the Asian economic region continues to do extremely well relative to the US. Now, I don't mean that means they have, stellar growth rates, but it's a more stable intra-regional trading economic community now. By that I mean trading between Asian nations is skyrocketing, has been for years. I started talking about this in 2009, 2011 as the next big trend of the next 1 to 3 decades was intra-regional trade growth in the Asian economic region, making it continuing to intensify the reality that that is a major economic driver of the world economy now. So economies like China, Japan are going to stabilize. South Korea should stabilize. Everyone in the region should be doing a little bit better in the years ahead, and vis-a-vis the West, probably outperforming. That will also entice Japanese fund managers, all Asian fund managers, sorry to single out the Japanese, all Asian fund managers to really think about maybe it's safer, given geopolitical risks, maybe it's safer, given the huge fiscal crisis in the US that could cause a financial implosion in that nation's economy at any time now, that it's better to invest the money closer to home in their own nations or in neighboring nations within Asia. And also, Asia will begin to look more and more, as it has been, towards Africa, I would think. So it really is still a situation of a Western economic slowdown. We saw manufacturing in the UK also contract yesterday. So manufacturing in the West, contraction, economies tinkering on recession, such as Germany, and I think, or having been in recession for 9 months now, 3/4, and I think the UK is going to have negative growth moving forward. And I wouldn't be surprised if the United States has negative growth by the end of the year, which would allow the Federal Reserve to cut rates. And everyone could get excited thinking that interest rates drive equity markets, when in fact, interest rates and equity markets are driven by the same stimuli, that is, the state of the economy and pricing and other factors. But everyone thinks the correlation means one drives the other. No, it doesn't. They react to the same stimuli, and you can have interest rates going up and an economy going up and a stock market going up at the same time, and you can have interest rates declining and a stock market falling at the same time. So the correlation over the long term is 50%. So there isn't really any lead indicator at all, but the market likes to think there is. And in fact, if you ask people what's the number one driving force of equity markets, they would tell you interest rates, but they're not. They're reacting to the same stimuli. So that's it from me today. I hope this helps. Don't forget, go to the website, cliffordbennett.com.au. Don't forget to go to PropX24, PROPEX24.com, which I'm very grateful for some sponsorship of these videos. Thank you very much. But go to my website too, cliffordbennett.com.au. Sign up for the free newsletter. I mean, it's world-leading insights at times. And even Bloomberg has said that about me, Bloomberg New York. So you get all of that for free. And of course, there's upsell options. But anyway, I wish you all the very best. I actually wish you, each and every one of you, a success today where you enjoyed the process of achieving that success. Thanks very much. Clifford Bennett.